Bitcoin is the world's best performing monetary asset, and fixed income is structurally incapable of keeping up with monetary debasement. The difference is that JPMorgan isn't buying Bitcoin, it's monetizing the demand for it. And here's the massive point that nobody is talking about. If the world's largest bank is building Bitcoin linked structured notes and has stated previously that it intends to accept Bitcoin as collateral, Bitcoin is breaking into the global bond market even more so than it has done for the last year with Strategy's preferred stock. Even a tiny allocation becomes seismic. Let's run the math. Global fixed income is $318 trillion. Bitcoin has 19.95 million coins outstanding, which is 95% of the supply that will ever exist. If just 1% of the global bond market, $3.18 trillion, enters Bitcoin through structured products like this, the implied Bitcoin price is $159,350 per coin. At 3% penetration, it's $478,000 per Bitcoin. And at 7%, which is the average allocation institutions give to alternative assets, that's $1.11 million per Bitcoin. This is what happens when Bitcoin becomes collateral for fixed income engineering. This is what happens when the bond world, the real plumbing of global liquidity, begins to reprice around a digitally scarce asset instead of government debt. And that's exactly what JPMorgan is doing here. They're normalizing Bitcoin-linked notes the same way they normalized interest rate swaps and equity-linked notes and credit derivatives decades ago. First gradually, and then all at once. And consider the timing. We're less than 2 years out from Bitcoin's next halving-driven supply squeeze, with annual issuance falling to only 157,500 Bitcoin per year. At today's pace, IBIT single-handedly absorbs more than that. Now add JP Morgan's new structured product families. Add Morgan Stanley's copycat note, which they will inevitably create. Add Citi, Goldman, and UBS, who will not sit out a $1 trillion derivatives revenue line. All of them will need delta hedges. All of them will need to buy exposure somewhere, and Bitcoin supply is practically not growing at all. JP Morgan just opened the door for the fixed income market to develop Bitcoin term structures, option surfaces, exotic notes, structured yield, callable Bitcoin debt, the entire ecosystem that turns an asset into a core institutional building block. And the final irony is that JP Morgan spent a decade attacking Bitcoin, and now they're attacking MicroStrategy, who pioneered the same strategy which JP Morgan is now copying. And now JP Morgan is literally designing products that rely on Bitcoin outperforming. When the largest G-SIB in the world embraces Bitcoin, even indirectly, the rest of the financial system follows. Not because they believe necessarily, but because they refuse to miss the biggest fee opportunity since mortgage securitization. This is an inflection point. Bitcoin is no longer a fringe asset, it is becoming collateral. And once the bond market builds around something, it doesn't go back.